Well, welcome to the Startup Espresso. I'm Hall T. Martin, the host of the show, where we talk about raising funding for your startup and the time it takes to have an espresso. I hope you enjoy this episode. Hello, this is Hall T. Martin with the Startup Funding Espresso, your daily shot of startup funding and investing. Venture debt is on the rise in the startup world as more startups find it useful part of their fundraise strategy. It's a form of debt financing for venture-backed companies that lack the assets for traditional debt funding. Venture debt has been around for as long as venture capital has been writing checks for equity investments. It's often used in conjunction with an equity fundraise. It typically runs for 3 years and is secured by the company's assets. Venture debt reduces dilution and gives the startup more runway before the next fundraise. It lets the startup acquire more capital without setting a valuation for the company, which is advantageous in advance of a new round of equity funding. Venture debt does not take board seats and is often cheaper than bank loans. Venture debt is more quantitative decision than equity capital, which is more qualitative, so the closing is typically faster. The disadvantage is that it must be paid back in the near term, and interest rates are typically higher than bank debt. Thank you for joining us for the Startup Funding Espresso, where we help startups and investors connect for funding. Let's go startups into today. Hall T. Martin is the director of Investor Connect, which is a 501c3 nonprofit dedicated to the education of investors for early stage funding. All opinions expressed by Hall and podcast guests are solely their own opinions and do not reflect the opinion of Investor Connect. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions.